congratulations on completing fundamental analysis. We can put a nice check mark on that. And technicals. And we just finished a very robust section of cash flow. Now we're ready for risk management. And it makes sense to do your fundamentals and technicals first before you take a position. It makes sense to do the risk management before you pull the trigger. So even though this is the fourth pillar, it is the number one in importance. And you think about it, we're going to talk a lot about this here, is again, this is just gathering information. These are facts. So, maybe it's a fact that a company is doing well, and it's just a fact, the numbers are there. Or maybe it's a fact that they're not doing well. And maybe it's just a fact that the stock has been going up, people are buying it, it's in a nice trend. Or maybe it's a fact that it's going down. These are facts. Okay, they're not up to subjection. The earnings are either there or they're not. It's either going up or it's going down or it's not, right? And so when we look at these facts, we position ourselves based on facts, not on whims, not on hope, not on gut feelings. We position based on facts. So there you have it. Except guess what? Sometimes these facts change suddenly. And so you have this thing called sudden change where it doesn't continue to do what you thought it did. We always invest based on the facts, but sometimes that face turns into that face and they exchange, and sometimes these trade places and it goes down. So when we have a sudden change, right, that's when we've got to have a plan and risk management. And we're so grateful for the guys on our team, particularly Corey Halliday. He's an options principal, which means he manages the risks on a trading floor with hundreds of traders. And it's job for him to make sure there's not too much risk out there and how to manage it. So I really recommend, if you have not gotten into the coaching program with Corey's team, get in there, because that will be huge for risk management. Make sure you're in Mentor Club, because we always manage risk there. I'll give you a couple examples from Mentor Club in here of when we've managed risk. And then also the Ultimate Options. It's a massive class. And I'll tell you, I don't take that lightly, because I've had people write in and say, gee, that was like a college level course. Well, yeah, it feels like it, because it's long, it's big, but there's a lot to talk about. So let's hop into the fourth pillar, risk management, and talk just a little bit about identifying several kinds of risks that are very common. We'll talk about risk related to control in a separate section. We'll learn how to use the computer a little more. We've been doing a lot of risk graph stuff. We'll do a little more of that. Risk management techniques. And I'll tell you, overall, in addition to the specific techniques, I promise to keep this thing as big picture as I could. There are overall concepts to know like this, that if you understand the technique without understanding this concept appears not as robust. It's not as complete. So that's important. We'll hit diversification, kind of knock that off its pedestal a little bit, because I'm not impressed with diversification. So we'll talk a little bit about that, simply because so many people say, diversify, now you're safe. Whew, not true. Not true at all. And then we'll talk about risk and education a little bit more. The disclaimer we always do with each pillar. Every time we start a new pillar, we hit this. 3 things to highlight. Number 1, education only. You should know that by now. We don't make like earnings claims. Oh, you're going to make this much or that much. Just assume no monies. You're here to learn. We're not here to trade. We're here to learn. We're going to do everything in a virtual account. And if you do that in a virtual account, I can guarantee you no money and no loss. And that's the only guarantees we make. Get in the virtual or the paper trading account. That's where this is done. We move forward on that basis. And then finally, this last paragraph, all investing and trading the securities markets has risk. That's why we're doing the risk pillar. And then we check in with the education continuum every pillar. How are you doing on this continuum in terms of fundamental analysis? Do you feel aware, competent, starting to get proficient? How do you feel in terms of what technical analysis is? Did this course help you move forward? Did you learn some things? Was the cash flow section when we talked about all those positions of leverage and options and stocks and selling and promises and choices. And then now let's see if we can move along with risk management. How do we batten down all these hatches? Legislative risk is like California. Ford is building cars, Chevy's building cars, and all of a sudden the California legislature says, well, we have special emissions. We want our air to be cleaner because we have too many people. So they make a new rule. Or maybe you're selling marijuana. Hopefully you're selling it, not smoking it. And you're selling it illegally federally, but maybe legally in your state. And all of a sudden they get tired of it and they say no more. Look at the people who are vaping. Vaping was a big deal. Oh yeah, cigarette smoke is bad, but vaping is tasty. Next thing you know, people are having problems with vaping. So they say, hey, we're going to raise the vaping age, or we're going to legislate vaping. Well, if you're in that business, that affects you. So legislation can cause problems with a company or stock you're investing in. Geographic risk. If you're in Florida, they grow oranges. They don't do that in Alaska. We're used to it freezing in Alaska, but if you have a freeze in Florida, that's not geographically common, and boom, next thing you know, we got orange crops that are frozen. Boom, Eddie Murphy is going to bet on orange juice in trading places. Political risk is more like, it's not really Democrats and Republicans. Warren Buffett, he's invested in stocks under every U.S. president. He's done fine on every one. It doesn't really matter who's president to us, but what we do care about is stuff like war and terrorism, and stuff like that is brutal. Nuclear war, that would cause a blip in the stock market, I would think. Obsolescence risk. I mentioned in the last segment we used GameStop as an example of a put option that turned out for us. Well, a lot of that's because they're becoming obsolete. The idea of going into a place and actually buying a physical disc, that's like 8-track tape stuff, right? You download stuff. That's just how it is. So technology, pharmaceuticals, one pharmaceutical comes out with a bigger, better drug. The other one's obsolete. The technology comes out with the new, iPhone or whatever, and the old ones are obsolete. And so that's always happening. Interest rate risk affects things. Obviously, the Fed can change the rate, and holy cow, look what happens. Counterparty risk, everybody knows what that is. If you have another party that fails to do something, it affects you, right? So you have counterparty risk. Ignorance risk is the biggest one. If I don't know what I'm doing, it's risky. Purchase risk. And I could go on. And it just seems like, I could go on for page after page after page with all these risks, and pretty soon you feel like, this poor guy right here. So I thought that was fun. I don't know, maybe that's dumb, but this poor guy is just trying to get his acorn, and next thing you know, there's all these things happening to him, and he's trying to handle one and trying to handle the other. He's trying to handle them all as individual things, right? Every time he plugs one, another one comes out, and it's a big one. Well, the biggest risk of all is the one I haven't even thought of yet. In fact, there's risks that'll hit this market that I don't even know exist. I see a lot of storm clouds on the horizon, right? I see that systemic risk with with the entire system. I see a lot of risk out there where I'm concerned. But God, what about the one? I had a buddy of mine who was trading American Airlines, and he bought a bunch of puts because he thought they were in trouble. Next thing you know, 9/11 happened, and he felt so bad about all the money he made, he donated it to the families of the victims who were killed, because you just had no way of predicting something like that. I don't know when the next 9/11 is going to happen. I just don't know. So we're going to talk about a way to handle all these risks, but there are 2 or 3 that I think are important to watch for and know, but we're going to solve all of them here coming up here. We're going to really address and say, hey, how do you address all these risks? So first one we'll talk about is purchase risk. Of course, this is when you lose power of your dollar. $1 a gallon to $10 a gallon. Well, my gosh, the gallon didn't change, but it's taken a lot more of these to handle. So this is a big one for savers. And if you think we're printing money, purchase risk is a big one. There's something called a non-systemic risk. Back then there was this thing called British Petroleum, BP, and then it started Broken Pipe. And you'll notice it went from $60 to $30 in a couple months. That's called a non-systemic risk. Why? This is important just for jargon. Is because BP, this was BP's problem. Apple's still selling computers, right? Costco's still selling groceries. Starbucks still selling coffee. They're not affected by this as much. But so what happens is, and I'm going to go off the diversification a little bit here, is people say, well, let's say you put all your money in BP, all of it. You just went all the eggs in one basket. And if you did that, you'd go from 60 and half your money be gone. So people say, oh, don't put all your eggs in one basket. Well, that's not true. All diversification does, okay? Not putting your eggs in one basket and spreading them out. All that does is attack non-systemic risk. So think about it like a flu shot. Diversification is kind of like a flu shot. Flu shots are for the flu. They don't help you with heart disease. They don't help you with your diabetes. They don't help you with gout. They don't help you with appendicitis. They help with the flu. And so when people say diversify, well, yeah, great. That might address some non-systemic risk, because if you only had 1% of your money in this and it fell, now you've only lost 1/2 of 1%, and 99.5% of your money is still doing fine. And they love you to diversify because, it makes them easy for them to say, oh, now just, you got to take what the market gives you, and it doesn't take a lot of creativity. I mean, think about this. Does it take any genius to diversify? Does it take any brilliance to go buy the S&P 500? Do you need to go to a broker who's been highly trained in whatever they're trained in to do that? No. It's a flu shot, and it's for the flu. Well, you might look at diversification that way, is that diversification only addresses the non-systemic risk. It does not offer protection against things like this. What if you're in the S&P and the whole market collapses? Well, now you're not like Warren Buffett, who has like 5 companies that make up, half of what he's doing. I'd say right now, 20% of his money's in one company, Apple. 20% of the wealth is in one company. If you take Apple, Coke, Kraft Heinz, U.S. Bank, and probably one or two others, you probably got 2/3 of his portfolio. So if those companies survive well, he doesn't get caught in a landslide like this. But notice, here in a year, you've lost half if you diversified, and here in a year, you lost half if you went all in one basket. So with all these risks, purchasing risks, systemic risks, non-systemic risks, sometimes systemic risk is called market risk. With all these risks, what do? I'm going to tell you right now, defend your chart. It's really funny how, everyone says, oh, there's AI coming. Well, shoot, AI is already here. It's been in the markets for who knows how long. There's stuff, in my opinion, that's going on that most guys don't even know what these things are writing, when these algorithms are very complex, right? And so that's already happening. Well, think about this. As a basic trader, what can this chart do? It can go up, it can go down, and go sideways. And does it really matter what causes that? CNBC loves to suck people into this. Well, the market's going on. Well, why is it going down? Doesn't matter. If you're here at 100 and it goes to 50, you lost half. And if it's there at 100 and it goes to 150, you gain 50%. End of story. I don't care what makes it go down and what makes it go up. I'm going to prepare for that chart to move. So when I talk about that thing I couldn't see coming, I'm okay with that, because I say, okay, what if it goes down here? For what reason? I don't know. Maybe it's systemic risk. Maybe it's a non-systemic risk. Maybe it's the price of tea in China. Maybe it's something I had no idea coming. But the reality of it is the chart tells the truth. If it goes down, you lost some money. If it goes up, maybe you made some. If it stays sideways, you're stagnant. We're going to create plan A, plan B, plan C. And that way, no matter which way it goes, we have a plan that we can live with. Okay. It's a lot about knowing the outcome. Confidence comes from knowing the outcome. And so people say, well, I want to know which of these three it is. Well, if I have a plan A, I know what that outcome would look like. If I have a plan B, I know what that outcome would look like. And if I have a plan C, I know what that outcome would look like. And as long as I'm comfortable with all three, if I have a plan for all three, well, then any three can happen, and I don't care why. Now, that's not to say that I'm not going to pay attention on an earnings date where things can change. That's not to say I'm not going to pay attention to FDA approvals and systemic risks and non-systemic issues and obsolescence issues like, that we've traded. I'm just saying that with the 4 pillars of investing, let's back it up. With the 4 pillars of investing, what this really is about is change. Let's review that again. Look, we have facts here. It's not fiction. They're facts. And the company's either doing well with a smiley face or company's doing poorly with a frowny. If it's smiling and the trend is up, those are facts. And we're going to position ourselves to do well. If it's going down, we're going to position ourselves there. But if there is change suddenly in that, we are going to react. So defend your chart. Think about that as a concept right now, that we're just going to defend our prices. We're going to defend our position. We take a position, now we got to defend it. And there's so many different ways to do that with different techniques and options and tons of stuff we can do. So I'm going to leave this first idea. These are very short videos. They're very easy. The 4th pillar is the shortest pillar because there's just certain things we can do. But the overall thing I'm going to drill into our brains here is that we've got to defend our chart, our position. We've got to do things that can prepare us for success, whichever way that might be, not success, plan A's, plan B's, plan C's, techniques to learn how to fight and defend and adjust and move. Think of it like, the importance of taking action. The buy and holders say, it'll come back up. It'll come back up. We're going to talk about that. I'm going to give you a list of bankruptcies that didn't come back up. And even in the bigger, they say, well, you just got to look long term. If you look long term, everything fails. Let's say that you're in the Egyptian empire that lasted for 3,000 years. We always come back. Nope. How about the Roman Empire? Nope. And I've got a nice picture of all these different empires that never came back. Those economies died forever. So when they say, it always comes back, what are you looking at? 200 years? Really? 200 years? That's your sampling for long term? How about 10,000 years, right? What is it? So defend that chart. Play defense. My basketball coach, Rick Majerus, I was a lousy player, but man, we could play the D, baby. Take us all the way to the NCAA tournament with that defense. So defend your chart, defend your position. And when we come back, we're going to talk about how that's done in terms of control. When we come back, control.